Great. What we'll do now is have Céline back, and she's prepared, and she's done this before. This is actually she's prepared a presentation very similar to the one she gave at the Chicago Fed at the Liquidity Project Financial Market Infrastructure event that we had at the Chicago Fed, and I'll just welcome her back to give that same presentation. It's going to be very helpful for us, especially if we haven't been engaging with the concepts recently, to just revisit them. And I think we've been dancing around various issues in this conversation that I'm sorry I missed. Maybe somebody can recap it, but luckily it's recorded. We can go back to it. But with that, let's just welcome back Céline, and thank you very much for preparing your quick presentation to us.
Sorry, yes, I didn't realize I was muted. Can you all see my screen?
I can see you, not yet your screen.
No screen yet.
Okay, sorry about this. Oh, sorry about this.
No worries at all.
I don't know why you won't allow me, but maybe you can keep the conversation going while I'm
just curious. I'll just be market maker again here in the middle. But I'm just curious. There seems to be a meeting of the minds here a little bit, because usually we have quite a challenge keeping a conversation going for hours and hours, especially online. So maybe, what's going on exactly here? What are you feeling here? Is there something unique about this format that spurred this conversation, you believe? I'm just curious about your observation, just some basic insights. Or you all are just sort of really you've been looking for a village for these conversations to occur, perhaps. That's also a possibility.
I mean, I think it's nice that we all have this kind of common connection of the money view. So there's this kind of grounding that we all have, that a shared understanding that allows us to discuss other things.
Also, there's the sense that the old model is falling apart and something new has to emerge. And so we're at a critical moment, which stimulates a lot of conversation.
It seems that my computer won't allow my sharing as long as I record. The session is recorded, so maybe I can try sharing the screen and then you can start recording again.
Yeah, and while you do that, why don't you just send me the presentation, and I will basically.
I was going to say that too.
But I'm going to do what she just said. I'm going to pause for a second.
Presentation to you.
I have your old one, and I can share that if it did change.
Yeah, actually, I made some changes. So.
Oh, okay. Well, don't forget about that.
Yeah, just share with me, and then you can already have the floor.
Yeah. Apologies about that.
No worries. You work at a central bank. I'm sure your computer is airtight.
Let me know if you want me the changes in the beginning or in the end.
I changed everything, but
okay. I was hoping I could maybe help you out with the first pages if they haven't been altered, but okay.
Okay, I haven't gotten an email
okay, I
yet.
think you should have received it. Yeah. Sorry.
Okay, it's my email. Okay, I got it. Let me pull it up for everybody. And so while I'm downloading the presentation, do you think we'll manage with the 20 minutes that are remaining, Céline?
Yeah, sure. I'll try to keep the time. It's fine. It's okay. I'll just be faster on some concepts. That's all. No worries.
Cool. And we do have the liquidity happy hour to sort of extend the conversation. I'm loving how these analogies with elasticity and discipline now apply to our own sessions. So I almost have it, and then I'll share my screen.
Great. So meanwhile, I'll just put the usual disclaimer, i.e., views are my own or Perry's, but not, the views of the institution that I represent.
Totally understood you here in your private capacity. No, great. Now it's my PowerPoint who needs to take its time.
Okay, I think I will start without the slides, and you can catch up whenever. I think most of you already know about the Money View, but for those who don't know about the Money View, I'm really excited to give you this intro because the Money View has been a milestone in my intellectual growth, and I hope it will, be as mind-blowing as it was for me. So why are we interested in the Money View today? For me, the Money View is a very compelling framework that one is very close to reality, and two, that links the micro very well with the macro. Like with the Money View, we'll dig into the nitty-gritty details of the plumbing of the financial system, but you will identify what matters for the macro picture. So for me, the Money View was extremely useful in understanding the big picture on monetary and financial system. And it provides very compelling answers to key questions. So the question that I had that led me to the Money View is the question on financial stability. Why do financial crises occur? And as of date, I think the Money View has given me, the most relevant answers or, key concepts that help me answer that question. Other questions that I have, there are many questions that you could ask, but there are, what are central banks doing? Will the future be characterized by a multipolar currency world? Is there a limit to that sustainability, and what is that limit? And we're all thinking about that right now with debt exploding with this COVID crisis. And these are just a few examples of the questions that the Money View can help you answer. Now, what is the Money View about? Well, first of all, it takes money seriously. You know, like it says, hey, money matters. You can go to slide 3. Thanks. Money matters, you know, and when I say this to my neighbor or to my grandma, everyone is telling me, of course, money matters. Duh. But if you talk to economists, well, that's at least the mainstream or the orthodox ones, you know, that's might not be so obvious. And in mainstream macroeconomics, money is considered as neutral. It, i.e., it doesn't have any effect on real variables, at least not in the long run. This is how, you know, orthodox economists see it. Money is considered as a veil and is modeled as a numéraire in macro models, and at best it is modeled as a financial friction. So typical macro models or the standard macro models would not take money seriously. The money view, by contrast, takes the opposite approach and puts money at the heart of economy and the society. Mehrling states that societies are characterized by a web of time-dated promises to pay. So each economic entity, each person, central bank, company, whatever, is understood in terms of its obligations. Obligations owed to others and obligation accepted by others. And if you think, you know, if you look at anthropological studies, and if you think, you know, quite deeply about it, this makes sense, because it's through obligations that are either imposed by law or by customs that we live in society. Okay. In our modern economies, obligations take primarily the form of money and credit. Therefore, obligations are understood as promises to pay that are either owed to others, these are called liabilities, or accepted by others, which are called assets. In this framework, in this web of time-dated promises to pay, money is considered as a means of settlement of these obligations, i.e., when you pay someone, your obligation disappears. The money view is also a bridge between economics, which tends to focus on the past, as Jay mentioned earlier, and finance, which has a focus on the future. And in this way, the money view also integrates finance and sees finance as means of valuation of those time-dated promises to pay, and considers banking as a means of allocation of those promises to pay. So in this money view framework, every actor must manage the inflow and outflow of obligations, i.e., manage its cash flow. This is what we are doing as economic units every day, right? Such that every actor can settle those obligations when they come due. If an actor can settle its obligations when they come due, it can continue operating, you know, normally. If not, that person must dash for cash to avoid financial failure, which usually takes the form of bankruptcy. And this brings me to the next slide and to the first money view concept, which is Minsky's survival constraint. It says that at any point in time, your cash inflow must be greater or equal to your cash outflow. And therefore, with this principle, the money view puts liquidity on the forefront. Okay, so the survival constraint is about funding liquidity. Yeah, then I will skip. Okay, then yes. So the question is, what type of money can you use to meet your survival constraint? to settle what type of credit. And this brings me to the second principle, one of the key principle of the money view, which is on the next slide, and is the hierarchy of money. So Mehrling views monetary systems as hierarchical. In this hierarchy of money, it is difficult to draw the line between money and credit. What counts as money and what counts as credit depends on your point of view, i.e., on where in the hierarchy you are standing. So at any given level of the hierarchy, the upper level is money, i.e. the means of settlement, while the lower level is credit. So to give you an example, if we start from the bottom of the pyramid, securities are a promise to pay deposits. In other words, deposits are means to settle securities. If we move one layer up, in the same way, deposits are a promise to pay currency, right? Because when you have $1,000 at the bank promises you $1,000 in banknotes. So it's a promise to pay. Obviously, the bank doesn't have enough banknotes. Everyone goes to the bank to withdraw their money, but it's still a promise made by the bank. And in the same way, the national currency is a promise to pay the US dollar. And the reason why the US dollar is at the top of this pyramid is because it is the international currency today. If you click on next, Jay, yes, thanks. So the hierarchy of money is dynamic. It expands and contracts. So usually during good times, it expands and flattens. So the hierarchy of money is not so obvious anymore. It's very easy to convert one layer to the other. But then during crisis, there's less credit, less money, that the pyramid contracts, and the inequalities between all the types of money is felt in a stronger way. Next slide, please. So you have key players that are called market makers that are in charge of ensuring the convertibility between one layer and another. And if this there's a price associated to that convertibility, the price of money, as you can see in green on this slide. If market makers are unable to ensure the convertibility between one layer or another, then you get usually that's when a crisis happens. So for instance, I was talking about everyone going to the bank, getting their money out. This would be a bank run, and this would be, result in a banking crisis. So now I'm going to delve into each of those key players by starting with banks. So yes, sorry. Yes, I forgot about this. So this is another view of the hierarchy of money. And you can see that at any moment in time, market makers, so those key players that are ensuring the convertibility between two layers of the hierarchy, are straddling two layers of the system, with one leg in one layer and another in another layer. So again, to those who are not familiar with balance sheets, assets is what is owed to you, and liabilities is what you owe to others. And typically, each player creates liabilities. So banks create deposits, central banks create currency. And now we can start talking about each of the players. So starting with banks, they create money with a swap of IOUs out of thin air, basically. So here you have Bank A, who is going to give a loan to Elliot. So what it does is that if Elliot wants a loan, it creates, the Bank A creates a loan and creates deposits at the same time. So the loan would be Elliot's IOU towards the bank, and the deposits would be the bank's IOU towards Elliot. So it's exactly a swap of IOU, and it just created like this out of thin air. So maybe you can, then you will ask me, but hey, how does the bank get away with it, or how does Elliot get away with it? Because this was one of the questions I had for a long time, well, the short answer is, as long as Bank A and Elliot can meet their survival constraints, it's fine. Okay. So, for instance, if Elliot wants to wire money to his friend Angela, who has an account at Bank A, well, it doesn't change anything for Bank A because it doesn't change its obligations towards third parties. Now, if Bank A needs to pay someone outside, so if Elliot needs to pay someone outside of Bank A, then it would need to go through the payment system, which we can see on the next slide. Yes, so here it's a little bit more complicated. So you can see that we can find Elliot's and Bank A's IOUs, and for the purpose of the presentation, I added reserves and deposits for Bank A. And in this case, Elliot needs to pay Angela, who has an account at Bank B. So what happens is that Elliot will tell Bank A to wire its loan to Bank B or to Angela. So you can just click on next. Yes, so then Bank A will use its reserves to pay Bank B. And at the central bank would just change Bank A's name to Bank B's name and credit Bank A's reserves to Bank B's account. And then Bank B can then credit Angela's account with the deposits that were wired from Elliot. So this is how the payment system works. And as long as Bank A has enough reserves, then it's fine. It can get away with this money creation. Now you may ask me, but what if Bank A doesn't have reserves? What if Bank A doesn't have enough reserves? Well, Bank A can always borrow reserves from other banks or other financial other banks. And then you can ask me, what if other institutions, nobody wants to lend to Bank A? Well, as a last resort, under certain conditions, Bank A can always go to the central bank and borrow reserves, and in which case the central bank will then act as a lender of last resort. Now, moving on to the second key player of this hierarchy, which is dealers. So that would be the key player at the bottom there. And I think the Money View really puts an emphasis on those actors. So what dealers do in practice is that they ensure market liquidity. Just to make sure that we're on the same page, funding liquidity refers to the fact that you can meet your financial obligations when they fall due. This is your survival constraint. Whereas market liquidity refers to a different definition of liquidity, which is characterized by the fact that you can buy and sell quickly in volume without moving the price much. So you would avoid prices jumping up and down like in the right-hand side of this chart. So how do they do this? How do they provide market liquidity? So maybe you can move to the next slide. Thank you. Yeah, so you can just click. So they do this. So dealers provide market liquidity by creating markets. That's why we sometimes call them market makers. Okay, so in my example here on this slide, you have a government that issues government bonds. They do this on a regular basis, okay? And the government doesn't have the time to find every single investor in the world to sell those securities to. So in practice, what governments do is, and usually for all types of issuances, this is what, you know, how it works. You go through banks. So governments issue securities first to dealers, which then take care of finding end investors on the market. So dealers buy directly government bonds and then sell them at a later date to financial markets. And by doing so, by buying at a bid price and selling at an ask price, they make a profit. In practice, this would be investment banks at, so you can, go on, thanks. And again, until the next slide, thank you. So to understand the economics of the dealer function, we have the trainer model, where the trainer model shows the ability of a dealer to change the price as its inventory changes. So here, max short would be a no securities position, and max long would be 100% securities position. So the whole balance sheet is made out of securities. And basically, you can see that the bond price decreases as the dealer inventory increases. Sorry. The reason why the dealer is doing this is because as its inventory gets full, the dealer is lowering the price to protect himself from the risk that the price may rise. As you know, as the inventory gets full, it might become more and more difficult to sell the securities. So the dealer would lower the price at which it acquires the security to avoid that it sells it at a higher price later on. And now we come to the last key player, which are central banks, last but not least. So to make a long story short, if you move on to the next slide, what I really liked about Perry Mehrling's approach is that he really showed me how the role of central banks evolved from, you know, being a lender of last resort. This is what we mentioned earlier when we were talking about banking, to dealer of last resort. Yeah, again, to make a long story short, what happened during the great financial crisis, which, you know, really, changed the role of central banks, was that you had those securitized products that were rated AAA, but most of them were packaging or came from subprime mortgages, which were quite risky assets in the beginning. And basically, in the run-up to the great financial crisis, those securitized products were sold everywhere. They were considered as super safe. They had great ratings, and they were used also for secured funding, so repo transactions. But at some point, people started doubting about the quality of those securitized products and started, selling them. And then market liquidity on those securitized products started breaking down, which in turn affected the funding liquidity for US and EU financial institutions. And as a result, central banks had to step in by backstopping markets, i.e. by making markets for those products that nobody wanted in order to safeguard financial stability. So they had to step in as dealers of last resort because private markets, private dealers were not willing to make markets anymore. Yeah, I hope this was clear. And I conclude by quoting Zoltan Pojar, who says that Perry Mehrling is not a monetary theorist, but a monetary realist. And I would really agree with that quote. And I really encourage you, if you haven't done so, to go through the MOOC that is all free online. It's great. As I said before, I keep coming back to it. And here on this slide, I quote other work from Perry that I really enjoyed myself. Thank you so much for your attention, and sorry for the technical bug at the beginning.